everybody, it's Christopher from Serene Education. Just going to go over the four majors quickly for the second week of September. So that's Monday through to Friday. What's that? Monday the 8th, right through to Friday the 12th of September. So quickly, just looking at the euro to start with, looking at the monthly. So gauging long-term sentiment. Clearly here you can quite clearly see that we've not seen any progression to the upside for euro, if long-term straight away, and that leads us into where price is trading right now. I mean, this is where we make our hard-earned money, and you can quite clearly see that price has pretty much stagnated, and we failed to see any new highs going through the earlier parts of this year, and subsequently that long-term trend came to play, which indeed cancelled out the intermediate trend up. Here, quite clearly, bearish engulfing candle, and subsequently since then we've seen nothing but shorting. Very negative news for euro over the last 4 or 5 months. That pretty much leading up for interest rate cuts on 2 occasions from Draghi and his sidekick. So straight away here, long-term sentiment negative. So therefore, looking at my weekly, my daily, my 4 hour, I'm looking for that negative sentiment to follow through. And if I'm looking for any opportunities, they would be on the selling side, not on the buying side. Because of that, clearly a long-term resistance has now taken away all that bias that we've seen over the past 2 years. In fact, taken all that bias off the table, and the longer price actually went sideways, the more selling pressure came on board, and the more buyers stepped away from the market, which then in turn led to this negative scenario outcome. And subsequently, we are now looking to the downside. The long-term target, always look to see where price could end up to. I mean, it could always go back down to zero, but between now and zero, the big one that we've noticed, which has been a major factor over the years, has been the institution moving average on the monthly time frame. You can quite clearly see this green line at the bottom here, but roughly around, we'll go for roughly around the 12,177 and change mark. And to give you an idea, rough idea of how many pips are still on the table to that level, we're looking in excess of, what are we looking at, 770 odd pips. You're not going to get all of that, but more than enough on the table to see a great return over the next couple of months. And for the foreseeable future, it does indeed look very bearish. You can see quite clearly on the monthly, once we failed to see price making any new highs, price fell a long way to the downside on a number of occasions. 2009 to 2010 support, 2010 highs to 2012 low support. And you can quite clearly see here June or December, January 2014 highs to could be probabilities there to see them heading back towards this level again. So we're looking for negativity, and just a quick fib retracement would give us an idea. We've gone through the 23.6 quite comfortably, through the 38.2. We're heading through this month, heading through the 50. So as long as you can stay below the 50% fib retracement level, let's just mark that off quite clearly here, we should be heading towards a 61.8. So if I can just mark those 2 levels off on my monthly, so when I drop down to my smaller time frames, like my weekly for example, let's have a look at the weekly. There we go. These are clear-cut areas that I would want price to be moving between. So that level there, which will now constitute to my resistance level for price, and that will be my support level I'm working towards. So you can quite clearly see last week very, very negative indeed. You can see that the intermediate trend now for the foreseeable future is to the downside. Swing low, swing low, swing low. So straight away, my psychological imprint going forward is I'm looking for negative opportunities intraday. Okay, I'm not looking for buying opportunities. The long-term trend has been negative. There's a lot of negative sentiment behind price pushing it lower. Why the hell would I want to start buying? All I've got to be wary of is price support and resistance levels. There's clearly one here. We have drawn that lower one at 61.8. You'll notice over a number of periods of time, especially through the earlier parts of 2013, in fact, we saw a number of support levels being forged at that level. So ideally, where price is trading right now to that level, there's still an excess of 150 odd pips. There again, you're not going to get all of it. Ideally, you would like to see price closing below last week's low. So you can see there's been a slight consolidation at last week's low, and so I'll just change that color just so you guys can see it. So this week, as long as she maintains below the 50% retracement or the 13018 level, I'm still looking for selling opportunities. And the near-term target level for me would be roughly around the 1279 and change. But I need to see price trading below last week's low. So that's 1290. Get a close below that, and then look for an entry intraday, ideally on the 4 hour, for a nice take of profit, roughly around the 1279 going into Friday of this week. Sterling, okay, bigger picture, monthly charts. You quite clearly see that we had a very bull run up until recently. We actually saw price trading above the institution moving average, which is a clear, or has been, or was a clear resistance level for price over many a year. I mean, this goes back to way before, after the 2008 drop. Here, resistance, 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 and then we had the breakout. However, that follow through did not come out. It just failed to push any higher, and subsequently what happened was we had a sharp pullback towards that institution moving average. And what's happened right now as we speak is price has actually closed lower than that institution moving average. So here again, looking for negative bias, because once it got below, if it had remained above this green line, which constitutes my institution moving average on my monthly, if price had maintained above that level on that pullback, I was still looking for upside favoritism. Okay, I was still, my long-term sentiment would still be to the upside, and you can see that the overall trend to the was to the upside. Swing high, swing high, swing high, swing high, swing high, and then breach of that swing high movement through here. However, I was still looking at my institution moving average on my monthly as my safety net, long-term safety net. The price just shot straight through it and actually pulled back, and then that's what happens with price. Price actually, when she breaches a major support and resistance level, she's either going to break. Here's a good example of that level here: resistance, 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 breakout, and then she has a consolidation period where a lot of work was done to actually break that resistance level. So people take the actual market takes a bit of a breather, and then once she's collected her thoughts, and as long as she maintains above what was prior resistance, and she maintains above that and forges a new support, then she's going to head higher, and vice versa. That's what's occurred right now on the pullback. We'd like to see the pullback happen and then price to actually consolidate in around or above the 166, which is my monthly fib. That failed to materialize. Price broke straight through it quite aggressively. Then we had this consolidation, and then everybody just jumped in, because price actually trading lower on a monthly time frame constitutes to a very negative outcome for sterling, or was a very negative, and everybody looks at that as an opportunity for further selling or bias to come into the market, and subsequently we have a sharper drop because of that. We also have the fundamentals that actually stack that up, but that's how, just by looking at price and how she actually reacts around major support and resistance levels, gives you an idea of what should be doing the bias long term. You can see the indicator box over here, for example. The long term sentiment starts to look patchy. Before it was predominantly very, very blue. Now it starts to get more and more negative the longer we've failed to see new highs on the monthly, and we're starting to see more lows. And you can see the intraday bias is very much in tune with negativity. A lot of red on all our indicators, and the R squared is complementing that negativity. So it's telling us that the bias on our daily, 4-hour, hourly, 30-minute, etc., is very much to the downside. So why would I look for buying opportunities? I would then, as long as she maintains below that monthly fib level, below the monthly fib level, I should be looking for further lows. Okay, I can then pull out a fib retracement level indicator. So there we go. Just slap on the fib, because this level down here in 2013 was our current all-time low to our current all-time high that we saw in 2014. You can see the 23.6 was not too far from that monthly fib level. Straight through it, pull back, and now the 23.6 level, now my weekly, my daily, my 4-hour, etc., now constitutes as a resistance level for me. So if I'm looking to trade intraday, guys, and that 23.6 level is above price, to me it's resistance. Okay, it's a very strong resistance level. I'm not going to look for buying. I would then have to see price closing above that 23.6 level to constitute a genuine buying opportunities. So that would indicate that this was just a pullback and a long-term trend, and therefore I could look back towards these highs. Failure to do so then puts more negativity or more selling pressure. Therefore, if I get to close below intraday of the 165.70, okay, this little consolidation we saw here, then ultimately straight away I know where my target is, the 38.2. And I was actually able to take a lot of profit on this particular pair. I am still in this pair. tight stops after non-farm payroll, and we saw a drop for sterling overnight. But nonetheless, looking at some really healthy profit for sterling. In fact, I'm up 377 pips on this particular pair because I know psychologically I should be looking for selling pressure. My indicator box is telling me I should be looking for selling pressure, so therefore I'm looking to the downside. And my next potential target on this particular pair is towards my 50% retracement level, which is my institutional moving average on this chart. So the weekly, another 166 odd pips to that level. Okay, so selling pressure, therefore looking for selling opportunities on sterling until further notice. Okay, then on to the US dollar Swiss franc. Now, euro is negative, therefore we should see positiveness on the US dollar Swiss franc. It is what it is. The correlation is there. It has been and will always will be. So you can see that the euro chart indicator was pretty much negative. In this case, it's the total opposite. So let me just show you the euro. There we go, a lot of negativity, and the Swiss franc, a lot of positiveness. Okay, but saying that, we have been in a very negative trend. You can see that all from the highs way back in 2000. In fact, we saw resistance level highs at 179, and the US dollar has never been able to get up to those levels before. And subsequently, in doing so, posting new lows over the months every year since then. However, we saw back in 2010 a morning star formation, a very aggressive change in market sentiment for the US dollar against the Swiss franc. And it was primarily because the Swiss franc was getting sick and tired of seeing a very negative US dollar cross, and therefore we saw a lot of intervention from the Swiss National Bank. We subsequently saw price pulling back quite aggressively. However, price is still maintained below the major support and resistance level on this chart, roughly around just short of the 1,000 mark from the January 2008 levels through 2009, but you can see quite clearly here a very long pronounced support and resistance level for this particular price. And intervention here, we saw price moving higher and on the bounce failing to actually breach this level. Okay, and always think to yourself, whenever you look at a chart, you want to be trading positive or negative trend, and for price to make a positive or negative trend, she needs to be making higher highs for a positive trend or lower lows or lower highs in a negative trend. Okay, so the first thing you do when you look at a chart is you want to gauge long-term sentiment or gauge the sentiment. Is she making new highs or is she making new lows? And does that all constitute to what long-term price is doing? That's all I do, guys. It's very simple, and you can do that with all the pyrotechnics that is the templates, etc. You can just get naked price on chart, draw a couple of support and resistance levels, look at the long-term trend, and the price is telling you all you need to know. What Nikki and I have done over the years is we've actually taken a number of indicators, put them all on the charts to actually work with what we already know. Okay, that's what we're doing as traders. We're trying to build up a stronger probability of what price is likely to go forward. So that's what it is. Okay, we know by looking at our long-term sentiment, we know by looking at what price has been doing. If she's not making new highs and new lows, then she's more likely to be more consolidative. And you can see, this is a good example. You can see how the US dollar Swiss franc, for most of 2012 and 2013, in fact, actually went into this consolidative range. She failed to break the major long-term resistance, support and resistance level here at 99, or just short of 1,000. And when she pulled back, she failed to break the prior low that we saw back in early January 2012. And that pretty much set up the whole trading sentiment for the 2 years prior to 2014. From 2012 to 2014, we've just seen price moving back between these 2 points. Through 2013, however, she's still making new lows. Okay, and when she did breach this level, let me just pan here so you guys can see this. When she did breach this consolidation level here, she failed to get enough people on board, and it was pretty much a fake out. Not enough bearish sentiment or sentiment moved into price, let's put it that way, and we failed to see any new lows going forward. In fact, we saw a consolidation where a lot of spinning tops, in fact, and we don't trade spinning tops or dojis because they are clearly where buyers and sellers are not agreeing on the market, and the longer that happens, the more indecision comes to the foreplay, to the forefront, which then in turn leads to a lot of indecision or speculation, and we don't want to be trading that. that's not what we want to be doing as traders. We want to see, in this case, if this was a genuine sell, and it was clearly, just looking at all the setups, we had a red arrow, red candles, have been red candles. There's never been a blue candle on this chart for as long as I can remember. All the moving averages were above price, the RMO below, the OSMO below, everything looking fantastic, but we just didn't get that follow through. And subsequently what happened was the more selling procrastinating that failed to get on board, then the bias switched. And subsequently, over the past couple of months, we've seen a lot of positive news coming out for the US dollar, which Intel has then pushed price back above this major support and resistance level, above the 89.59 and change, and now we're back within this consolidation range again. Okay, so the next target, potential long-term target, is either going to be this major level here at 99.167. But between where price is trading right now and that level, we've got a number of areas where we've had consolidation. This one over here, the last major swing low, which is around about the 95.90, that would be a particular point of reference. And looking at the sentiment here, predominantly blue. So therefore, when I went with my weekly, for example, we're above. You can see we're making new highs on the weekly. Blue arrow, blue candles, blue arrow, blue candles. RMO has been above. The OSMO has been building for quite some time, and that's what I keep saying to you. If price is not making new lows, then she's going to start making or consolidating. And when she starts consolidating, the longer that consolidation occurs, then you're starting to see people swapping. They're swapping their contracts. In this case, coming from negativity, not seeing any further bias, negative bias. So what happens is they start to cash in their chips, and vice versa. People who are looking for these opportunities, they will start to buy those contracts, and therefore we start seeing a change in market sentiment. And this is what's led us up to right now. So we had the blue arrow, blue candlesticks above the institution moving average, which is a clear sign of positiveness. RMO has been above the zero level, and has been above the zero level for almost going on to two months now, and it's been since the July 2013 levels that we've seen RMO trading back above the zero level. So that's a good sign. So now I should then look to areas of price support and resistance long term as my targets. So therefore we'll run about the 95.90, and then the big one will be the 99.16 or the 1,000 mark. So look for the upside for the US dollar Swiss franc for the time being. Okay, the last pair of this week is going to be the US dollar Japanese yen. And here on the monthly, always starting the monthly, very, very important. Here again, you can quite clearly see that since 1997, we've actually seen price falling. We've not seen any new highs since then, if you look at the longer term time frames. And in actual fact, if you draw a trend line over the major points of this downtrend, you can quite clearly see here, resistance level high, resistance level high. Look at price is doing right now on the hard right edge. This is where we make our money. You can see that price is now moving into this level. We had a tweezer top over here, and that's subsequently because price was heading into this level of major long-term trend, but also the institution moving average on our monthly. And not only that, but if you look back, you can see there was a long-term support and resistance level in around the same area. Price consolidated. It didn't stop straight on that level. It paused in and around that area. There, and there to a degree. Okay, so that level on my monthly is an area where you would have to put in a figure of support and resistance. That would clearly have to be on your chart, because we've seen price over a number of years, and this goes way back. We've seen price consolidating at this level, so you would have to be well aware of that. And you can see that ever since price has moved into this level, we've seen a lot of consolidation, a lot of hesitation. Price has been very hesitant, and subsequently we've seen sharper pullbacks, but we've seen the bias still favoring the US dollar against the yen to the upside. Yen is weak, has been weak since the 1990s. Yen's in a bad place, and subsequently the US dollar is also going to be negative in that time, but there's more the risk. There's less risk on US dollar apparently, according to the traders, and subsequently they've been looking favorable to the upside because of that. So going forward now, there has been opportunities in intraday, well, on our smaller time frames. Let's go down to the weekly. So you can see that on our weekly we have been in a nice bull trend for as long as we can remember. We had a huge building process through 2011, in fact, and then we had some fantastic unemployment figures coming out of the non-farm payroll way back in 2011, which started this building process. Okay, they were expecting really, really shocking figures for unemployment, and the unemployment figures, or the employment figures, came out way better. In fact, double what they were expecting to the downside, but led to this upside. And then we rallied into the monthly long-term support and resistance level, that green line. That's the line we drew on our monthly time frame. That's the major resistance level in this case, and price pulled back quite aggressively. And then we went into this consolidator range, almost this wedge, this flag formation. However, you can see the candlesticks still maintain their positiveness. Okay, so straight away psychologically, the template is telling you we should still look for a positive bias, and subsequently we did get the breakout, and we actually traded that breakout, and we made a nice profit through here, trading back up towards those major resistance levels highs. And when price got there, breached, pulled back, but failed to hang on to those prior resistance, now new support, failed to hang on to it, and subsequently price broke low again, then the pullback, and then the continuation lower. But we've gone through a major consolidation for this pair. We had, for most of 2014, in fact, up until recently, price went into this consolidated range. It went into a state of nothingness. It just went sideways. We failed to see any major attempts to the upside, and we failed to see any, well, we saw a number of attempts to the downside. He had 101.90 and change, but she failed to break those levels. And you can see the candlesticks still maintain that positive outlook, still maintaining blue. So therefore, you'd still have your bias looking up. The indicator box is still predominantly positive, especially on the long term. So yes, you're going to get a bit of negative intraday as we see pullbacks. That's going to happen. But the long-term bias is still one to the upside. So all you need to do is see a major support and resistance level being breached on these time frames, and then look to re-enter the market. Okay, there were up until recently, I had my trend drawn like this, my intermediate trend, the consolidation trend, because we were seeing lower highs than the prior ones. And subsequently we had a breakout here, and this break failed to break above this level over here, and then we had a pullback, and then the major influx came in. But you'll notice, whether you draw your support or trend line there, or you draw your resistance level here on the highs that you saw way back here in 2014, in fact, we had a very bullish breakout. Major weekly statements. It's a statement candle. It's an intense statement candle. In this case, up. Very little wick, very bullish bar, and all our indicators in favor. So therefore, the outcome is going to be to the upside. And subsequently, what it did was, if I just take this level now and move it to the upside here, just to give you an idea, you would have been able to profit on that outcome just by taking this and moving. There would have been 100 pips on the table straight away. But we're now at that major support and resistance level, and price is now consolidative. So the US dollar, Japanese yen for the foreseeable future, well, we have to look back to our monthly, because our monthly at the moment now is the one that's going to be the major factor, because our institution moving average is not far from that. And you can see that we failed to make any new highs at the end of 2013, in fact. So we are trading right now at that level. So I'm looking still bullish to the upside. However, I'm trading with a lot more caution, is probably the best word to use, because we're at a major all-time support and resistance level area. I mean, this goes back to 1999, guys. I mean, this level has been a marker in the sand for a very, very long time. Ideally, we'd like to be above 106.90 and change. But between now and then, if we do see a progression to the upside for this particular pair, it's likely to be very hesitant. So it'll move. If it does move and the people still keep adding more and more fuel, buying contracts to the fire, she's going to move with a little bit more hesitant or more caution, because we're at a major support and resistance level high. But if we get above this level here at 106.99, you're going to see a floodgates open for the US dollar. Primarily because psychologically she would have broken through a major support and resistance level, and that would in turn spur a lot of buyers to come to the market. And you could look at 109.96 as a potential target, but the big one that's likely to go to is this 121.089 for the foreseeable future. So we are at a level here for the US dollar, Japanese yen, where we could see some fantastic opportunities to enter for further growth to the upside. Failure to get above this level through September, guys. Okay, very, very important. We've got to see the building process, and it could take months. Okay, we've seen that with the US dollar, Japanese yen. It's taken months to get the opportunity just to get 100 pips from the bloody market over the past month or so. But you have to have that patience in trading. And in some pairs, it is like pulling teeth. But when the opportunities arise, you're going to see a greater movement in either direction, and that's what we're waiting for. So patience is a virtue, and those who are patient are always rewarded. Okay, I keep saying that, and you've got to be patient in currency trading. The markets have changed since 2008, and I don't think they'll ever take on the same outlook they had before 2008. But what we need to do as traders, we have to move with the times. We have to adjust, and those who have adjusted and made changes to their templates or strategy templates are the ones that are still profitable in the market to this day. So that's what we're going to do. So here for US dollar, Japanese yen, trade to the upside, but I advise a lot of caution with that, and yeah, keep it as exactly that. Very, very tight stops. Look at your money management. Don't over risk, and be well aware that we're going to see a lot of caution for the US dollar, Japanese yen going forward for this month in particular. Let's see how this month comes out. This month is going to be the game changer. It could be the exact same thing now. You had a very, very bull candle a number of months ago. Well, at the end of 2013, in fact, a very bull move to the upside. But then January took it all away from us, and that's what we've got to be that's what we've got to be well aware of. That if we are long here, that could actually be the outcome. So why do that? Far too much risk on the table. Rather let the naysayers, the speculators actually drive price, and when the big boys come to the table and they give us a decisive outcome, then we just jump on and we trade comfortably into the horizon, and that's how we're going to keep it. Okay, so try and take as much risk off the table and leave it at that. So otherwise, I'm going to leave you with that. Good 27 minutes of analysis this morning. Have a fantastic week, and I will catch you guys the following week. Until then, you guys trade serenely.